Welcome. You're listening to the Beyond 50 radio program, and thank you for tuning in. I'm your host, Daniel Davis. Well, all the world's ablaze, especially when it comes to the mortgage industry and the financial crisis here in the United States. We're going to take an in-depth look into what's going on here and try to understand what exactly happened and what we can do to be sure that, at least as individuals, that it doesn't happen to us again. Joining us here on the Beyond 50 radio program today is our guest, Richard Bittner. We're going to talk about his new book, Confessions of a Subprime Lender, an insider's tale of greed, fraud, and ignorance. And boy, do we want to know quite a bit about that. Just to let you know about our guest today, he was president and co-founder of Kellner Mortgage Investments. It was a subprime mortgage company that peaked at 65 employees and $225 million in annual loan volume. Currently, he is managing director for Housing Wire, a leading mortgage industry online publication, and he's here to talk with us about his book, Confessions of a Subprime Lender. And I'd like to welcome Richard Bittner to the Beyond 50 radio program. And how are you doing today, Richard?
I'm doing well, Daniel. Thanks for having me.
Now, your book is kind of entertaining. You know, it really opened my eyes in many ways because I was thinking to myself back in the 90s when we were beginning to see, I guess, the housing boom slowly begin to climb. I thought to myself, you know, there seems to be a lot of mortgage brokers. It was almost as though they did something that only Coca-Cola has been able to do, which is to be on just about every street corner in the nation. Now, talk about what happened here and how we became, for lack of a better word, infested with so many mortgage brokers.
Well, you know, it was kind of interesting. I think it was really countrywide. Angela Mozilla, who, of course, had founded the company and largely pushed this thing up the hill for 40 years, that saw the revenue opportunity back, as you mentioned, really in the early 90s and largely expanded his presence into what is largely being dubbed as the wholesale market, which, again, is business being done through brokers. Because of the ability to simply concentrate on those individual agents. And so as Countrywide and then eventually other lenders started to get into and develop platforms, it really created the impetus, the ability for individual loan brokers to have different outlets for loans, which I think is what sort of gave this industry the start, or that segment of the industry really sort of the foundation for growth. What I think allowed it to go to the next level, really we saw around the year 2000, between 2000 and 2005, as rates started to drop, as we still saw many states that had very limited regulations and controls for brokers in terms of minimal barriers to entry. We saw roughly, I think by estimates, approximately 100,000 new brokers that entered the mortgage industry from 2000 to 2005. And again, many of them unregulated and often cases in a number of states unlicensed, although now we've seen changes to that. But it didn't take much to enter and become a broker. And, you know, I'm based here in the state of Texas. I can even use this state as sort of an example where, you know, to become a broker today in the state of Texas, if you have no experience, ultimately you've got to attend a class for a couple of weeks, and you've got to essentially get a 70% or better on a pass-fail multiple-choice test. You know, for someone who is largely responsible for guiding individuals through the process on what is typically their largest financial decision, you know, that's not very stringent. And Texas standards are probably some of the toughest in the nation. So, you know, you kind of look at it and go, you know, to become a financial planner, to become a stockbroker, I mean, you've got some pretty extensive requirements to play in those arenas. Yet in this segment of the financial industry, it's still pretty easy to become a broker.
Now, what's interesting, too, and you said something that I remember experiencing at least 5 years ago, is the fact that we were in a mortgage company which, you know, had the brokers. And it was being explained to me actually by the co-owner of this company, which is a fairly large one in the state of Oregon. And she said, well, what we have is that you can learn how to do this and actually become a broker if you want to. And it seemed relatively easily, almost as though you spent probably a total of 6 hours over a weekend. And before you know it, you were learning how to do what that company was doing. And I thought, that's kind of easy. I remember years ago when I participated in getting involved in selling life insurance, it was required that you had 54 hours of class learning time and involved with the point that you had to score at least 95% or better on all the tests before you can even go on to take the state exam. I thought, geez, this is an awfully easy business to get into.
Yeah, and well, it's funny that you bring that up, Daniel, because my very first job in this industry in 1993 was for a company based out of Southern California. This is my first entrance into the industry 15 years ago, so I know nothing of mortgages.
Right.
It is a company that is selling business opportunities in the mortgage industry, and it's really about not who's qualified to sell mortgages. It's about who has the $10,000 to be able to pony up to work under their licenses and use their technology and their systems and their
Right.
lender base. And I remember scratching my head and thinking of this, going, people aren't being qualified based on their ability to succeed in this industry. They're being qualified based on their ability to cut a $10,000 check.
Uh-huh.
And I kind of looked at that and went, "Wow, is this how the industry really works?" Well, eventually I moved from there to a division of General Electric where they did it right, and we're a little bit more above board in their approach. So I went, "Oh, this is how it's supposed to work." And but what you mentioned absolutely resonates with me, because the point again being is that very few barriers to entry. In many states at that time, there were no licensing requirements, and even those that did, it was oftentimes just very simple filling out a form. So one could truly hang up a shingle and become a broker very quickly.
Now, here's what's interesting too, Richard, and it's one of the areas that your book captures so interestingly. Now, let's say 5 years ago, as I was beginning to take a look at the possibility of buying a home and the like, is that here we were at a mortgage broker. Now, here I believe a lot of people at least call them the subprime lenders. These are people with average to below average credit who are trying to get into the American dream. And as you were explaining in the book, this is why this particular industry was created, was to help that happen, because, as people are buying homes, that keeps our economy moving and so forth. But what was really interesting is that I thought that as I was talking with this broker, that this was the person responsible for loaning the money.
Yeah.
Now, as I came to understand, I thought, well, there sure is a lot of people out there who can loan money, but the point is, these people weren't really involved in actually giving you the loan, but they were involved in actually finding people to give you that loan. Now, let's talk about what a broker's responsibility is and how you can start seeing that gray area stretch into oblivion almost.
Yeah, well, a great point there, Daniel. It's a broker is just that. It is someone who is largely bringing two parties together to fulfill a need for a product or service. In this case, to fulfill financing for either a refinance or the purchase of a home, or perhaps a refinance for the purpose of taking cash out. So a broker is simply just a loan originator. There's someone who are not using their own funds. They are literally connecting borrower A with lender A to help facilitate this transaction. And so that broker gets paid in one of two ways, either through an origination fee that gets charged and paid directly by the consumer, or through what's called a yield spread premium, which effectively is a fee that the lender pays the broker if the broker has charged a rate that's an above average or above market rate. Now, lenders have the ability to also earn money relative to charging a rate that happens to be above par or whatever the going rate is that day. The only difference between the two is brokers have to disclose it in the form of a yield spread premium actually on the good faith estimate or final settlement of costs when a loan is closed, whereas the lenders don't necessarily have to do that. Now, there's a whole reason as to why that happens, and that's sort of a separate chapter and a separate conversation, but that's largely the difference. So, again, when you go back to motivations, if you're largely just, and I hate to use the term, a loan jockey, where your primary interest is simply getting the largest number of deals closed, and you have no financial skin in the game any way, shape, or form, it is difficult, I think, as a consumer, particularly since we've done such a great job of creating confusion in this space, to know whether or not the deal you're being offered is truly in your best interest. And unfortunately, the industry, obviously lost its faculties in terms of its ability to sensibly underwrite loans. So it made it simple enough by the time we hit 2004, 2005, where, as we know by now, frankly, anybody who had a pulse, who was willing to sign an application, had the ability to get some form of financing. And, when you're in a risk-based business, and again, when you break this whole thing down, all we do in this industry is manage risk. And when you can't effectively do that, subsequently we end up with the kind of problems we have today.
Now, what's funny, too, in the news, as we needed this large bailout that seemed to be put into a rush to save the nation, it's kind of, as you see something like that, you think to yourself, there's something shady right there. It's like all of a sudden this just happened, and you really need this to be done now. And I thought to myself, well, what's with the mad rush? And then all of a sudden you're seeing on the screen and newspapers and so forth is, all these people that are beginning to lose their homes, going into foreclosure, and so you can see where the fear is being put back into the public again. It seems to be the modus operandi of our government when they want something done in their favor, is that now that these people are in this situation, please do this to prevent this from happening. But then you just get a lot of confusion about the news and where the money is going and what it's going to do to actually help. But let's take a look at the relationship, first of all. We're in a subprime industry. Now, explain the difference between what subprime and prime lending is, just in case some of our listening audience don't really clearly understand what it is.
Absolutely. Subprime, again, much like the term might imply, is mortgages designed for people that are below prime credit. So typically you're looking for someone, although not necessarily, I don't want to put this in an absolute box, but if you look at credit scores that range from maybe a low of 400 to a high of 850, typically once you start falling in below the 640, 660 range, that's sort of when you start entering subprime territory.
Yeah.
Now, when the industry worked, when I first entered into it in the late 90s, we effectively manage risk. There were a number of investors, such as GMAC Residential Funding, who I worked for and then was one of my investors that I sold loans to, that didn't have any 100% financing, meaning the best loan that we had available was maybe 5 or 10% down. But, it had some pretty stringent credit requirements. If you had a previous bankruptcy, it had to have been at least, so many years ago. Again, it was about managing risk, and it was about looking at, number of lines of credit that somebody had on their credit report, and again, effectively managing through this whole process. What we found over time was that credit score in a normal market tended to perform, you could predict performance based on credit score relatively well, meaning that if somebody had a 600 credit score or a 580 credit score, we saw almost consistently a certain level of delinquencies that came with loans. So with that knowledge, with that understanding, you could then manage to the risk in general by saying, okay, we'll offer 100% financing for people down to X score, 600 or 580. Now, based on all of this other criteria, which meant, we need at least to see previous housing history that looks like this. We at least need to see trade lines on the credit report that look like this, employment with verifications of X, all of these other pieces. So if you held constant for all those other things, you could predict credit score performance fairly well under normal markets. Now, what happens over 5 years is that we start seeing a deterioration of the other guidelines. We solely rely on credit score, but we start saying, hey, you know what? Remember how we used to always say we needed a strong verification of rent from that borrower, which means that they're living in an apartment. I want to see either 12 months canceled checks, or I want to see a verification of rent form from a management company. All of a sudden we start changing guidelines and we say, we'll go ahead and take that private verification of rent. So what that means is that suddenly little Johnny, who's living at home with his mom, effectively produces the equivalent of a note from his mother that says, yes, Johnny's been renting here and paying $1,300 a month. And you laugh at that, but the reality is those are the kinds of things that we start to see going, no, the VOR, the verification of rent, doesn't have to be a what we call an institutional VOR. It can be a private VOR. So you start seeing those things chipping away, and you're going, hey, you know what? The 580 score, the 600 score performs like X as long as all of these other factors are taken into consideration. But when you start chipping away and saying, all of a sudden you're just left with the score, but the hell with everything else, you know what? It doesn't perform as well. You do that, and then what also happens is you don't price for the risk, which means that when rates start going back up and the Fed starts raising rates in 2004, what happened is none of the rates for subprime ever went up. When I entered the rates, the average rate for a subprime customer was 11, 12%. It wasn't designed to be financing for everybody. It was designed to be something that was short-term, couple of years, get your credit fixed, get out of the deal. Then it became financing for the masses. And, that's ultimately one of the reasons, as you know from reading the book, I finally got out in 2005, more than a year before this thing imploded, because I went, we're not managing risk anymore. I loved being a lender that lent money under these conditions when it was done intelligently. I took pride in it. And I know that people today probably look at that and go, what are you, nuts? Since it's become the newest, dirty word in the American vernacular. But, when you look over the 4 or 5 years I owned a company, and again, I'm not trying to justify in any way decisions that were made. Did we make mistakes? Absolutely. But, I look over the predominant amount of time that I was in business, and I look at low level of delinquency and default rates, and I'm going, that means we managed business effectively. We managed risk. But that last year, I saw it coming up, and I saw us making decisions where I'm going, this is insane. Why are we doing this? Even though the end investor, the Wall Street investor, has said this is now an acceptable level of risk, there does become that sort of gut-wrenching point where you realize and go, what? I can't effectively control this industry anymore. I can't compete and effectively manage risk at the same time. I'm out.
What I also found interesting, too, as we were talking to many different mortgage companies, some of them to take on the opportunity, of course, of sponsoring the program, we began to understand the industry a lot more, and what was quite interesting and alarming to me was the fact that it seemed there was a lot of what I would call sloppy money being made. It was just too easy. Now, you take a look from the broker standpoint, and you talk about the types of brokers, going anywhere from the honest broker all the way to the devious one that's actually out there just for themselves. And you've even shown examples, even in your own situation, where brokers had actually cost you money just due to poor loans, knowing that was going to happen in the first place. And just as you had mentioned, little Johnny living at home with mom, you found that customers out there who were desperate to get into homes that were within the subprime, perhaps even below categories you mentioned earlier, if you had a pulse and were breathing in and out, you were getting loans back at certain periods of time in the early 2000s. But you can see where people were saying, find any way you can to get me into a situation that I don't have any discipline or any habit to be in the first place. And you can see why this whole thing began to implode.
Yeah, you're absolutely on the money there, Daniel. It's one of the things I guess I really try to point out in this book is that we all want to blame somebody, and one of the things that I make clear is that the reason I think this is going to be regarded as one of the greatest business debacles in the history of this country is that it's not about a couple guys sitting up in a corner office that are creating a scheme to defraud somebody or shareholders, like an Enron type of situation. This is about the entire breakdown from one end of the industry from the other, from the broker to the lender to the investment banks to the rating agencies. And largely what I've tried to do is chronicle each piece and say, here's what they were supposed to do, here's what a lot of them ended up doing, and when you take this sort of collective effect, we've spent a lot of time talking about the broker. Obviously, that was my customer, and, there's a pretty colorful chapter, I think, in there relative to my experiences. But it's also only 1/6 of the book. And again, is it an important part? Absolutely. Is it the only part? No way. Because again, none of this ever happens if this money doesn't become available from the practices that are taking place in the securitization market. So, another big part of the reason why we're here today.
Now, when you talk about the brokers in your book, again, as I was alluding to earlier, is that you talk about the different broker types, ranging from your honest broker that sincerely says, well, let's take a look at what it is to manage your particular risk into getting you what you're looking for, and realistically helps place you where you belong based on your habits and your history, all the way to the guy that he's out just to make as much money as he can. Now, kind of go a little bit in detail about each one and what your direct experience was to deal with people like that.
Right. Well, I've kind of attempted to try to categorize different types of brokers, in sort of a 3-bucket type of approach, and the first is the typical honest broker, somebody who just, clearly has the best interest of the broker, of the consumer at heart, is also looking out for the lender, truly believes that disclosure, is full disclosure is the only way to go to everybody. And, there's a lot of brokers that operate out there like that. And those were the kind of brokers that to me were the ones that, you were certainly striving for. But, a great many of them, because of, I think, a lot of the large number of entrants, were very, as I classify them, as sort of dysfunctional. And I've kind of tried to break that down into 3 categories. One was a sort of a pusher, which meant that they really weren't deceptive, but they were always trying to stretch the limits of everything that they could. One of my best customers was like that, and every one of his appraisals always came in pushed, meaning that we could see that every appraisal was overvalued, 8, 9, 10% in our opinion, mind you. I've got an appraiser saying it's worth 220, but I'm sitting here thinking, okay, based on my backdoor diligence, I'm thinking this is probably more like 200, not 220 in terms of thousands. So an example of where somebody was always pushing the limit with this. The other two sort of subcategories in that group were also what I called sort of the withholders or the manipulators, which were just that, people who either weren't fully disclosing information, in which case if my QC department wasn't fully doing their job, I might miss something particularly relevant, or like a missing bank statement that might have something relevant in regards to depository funds. I mean, usually a lot of times we would catch that stuff. Sometimes the sneakier folks would get a few things by us, and then of course there are the folks a little bit more deceptive along that scale. The manipulators, they might actually be falsifying or altering income. They may not be. They may be pulling a bait and switch with the borrower, and that was one of the things we saw a lot of, and that was disheartening because you would see a borrower who was quoted a particular rate, and they believed that they had an 8% rate going in for 30 days, and subsequently at the end of the deal, the broker just literally, because they wanted to make more money, increased the rate, and the reality was, as long as legally they got the borrower to sign another good faith estimate of costs, there was nothing illegal about that practice. And the challenge is when a person doesn't have very good credit and they perhaps maybe gone to their bank and they've been rejected, and suddenly you've got somebody who says, hey, I can do this loan, and you've gone through this gut-wrenching process for 30 days, and suddenly you're at this point where you're like, wait a minute, I'm 24 hours away from moving. I've got moving trucks. I've got all of this stuff in place, and suddenly I'm finding out my rate has gone up. Whether it's for legitimate or non-legitimate reasons, what are my choices? Well, if you think that the broker is, pardon the expression, it's, taking you to the woodshed on this one, you've got options. You can threaten somebody. You can, threaten them to go to the Attorney General's office. But a lot of people, don't understand their options. They don't know what's available. They don't really know whether they're being treated honestly and ethically, or maybe they're getting, like I said, taken to the cleaners on this one. And those were the kind of deals that really frustrated me the most because I didn't have a relationship with the consumer. If I saw somebody that I thought was getting hoodwinked, it was kind of understood within the industry that you didn't go around your broker to the customer because that's not where the relationship was. And frankly, if you gained a reputation in the industry as being someone who did that, then you might have other brokers who might not come to you. So, the level of dysfunction went far and wide in this industry. And then, as you mentioned, sort of at the very end of the scale are really, the very worst violators, what I just largely refer to as the corrupt brokers, where I think the differentiation there is that these folks were just simply trying to make as much money as they could, oftentimes fabricating deals using what we called straw buyers, where quite frankly, unlike the other folks, at least at the end of the day, there was an objective to try to get a loan for a borrower that was legitimate, meaning they were trying to get into a house or get cash out with the intention that at least they believed the borrowers were going to pay. When you got to these folks at the very end on the corrupt side, and again, very, very small portion of the overall broker base, there really was no effort to try to actually create a loan with a purpose outside of anything except, taking it to the lender to get as much money and extract as much cash out of a deal as possible.
Now, what I found interesting, and I think it was about 4 years ago that I first came across this, when you talk about things such as ARMs, this is one of the lending ways that you went about getting a home, is that they started creating ARMs for people to where they were paying just the interest only. Mm-hmm. And there was a friend of mine and I, we were talking at one time, and it seemed like this became this big growing trend for people to get into homes. They could have already been in a home and they were pretty decent borrowers, good track record, but then they started trying to get into homes that were stretched so far beyond their means it was almost ridiculous and almost laughable when you thought about it. Like, what are you thinking? Going from $200,000 or maybe even $300,000 homes up to $400,000, $500,000, and $600,000 homes with the same income just because you can pay interest only. Yep. And so you can see people just began making choices that bordered on almost the ridiculous. So you kind of wonder, what were people thinking in those times?
Well, and that is the $64,000 question. And I've it's interesting. I was on a panel at Dartmouth a couple of months back with Bruce Marks, who runs a group called NACA, the Neighborhood Assistance Corporation of America. And Bruce and I tend to get into it pretty regularly because Bruce is convinced that there's absolutely not a consumer that is at fault for their actions in this entire mess, which of course I think is
After reading your book, you can say, is this guy out of his mind?
Well, and what's interesting is Bruce is a pretty smart, intelligent guy. He's done some actually very interesting things with NACA, and I applaud him for that. But that being said, he's completely on one side of the on the arena and going, it's not like 4 million Americans got duped here. Yes, the industry made some mistakes, but at the end of the day, people still sit down at a closing table with documents in English that very clearly say you will pay this amount of loan, and this is what kind of loan that it is.
Exactly.
And so, at some level as consumers, we have to all collectively take some responsibility. And, that's one of the great challenges that we see with this. We're in this great catch-22 because, yes, while certain consumers were duped, and what we're going to largely see is the government now swoop in, buy up assets, make massive loan modifications, which essentially means that they're going to write down principal balances to much lower levels where people now can afford to make them, reduce interest rates if necessary, which in many respects is a good thing because, yes, it does keep people in homes. The more you keep people in homes, the fewer homes that go to foreclosure, the better overall it is for the market. But there's the converse side of that says, well, wait a minute, what you're basically doing is saying that this behavior that we as consumers went through is okay. We're going to essentially throw you a lifeline and forgive you for that. And that's very interesting because when somebody signs a loan application, even if they did a stated income loan, which essentially means they didn't prove their documentation, and they signed an application that said, yes, I make this amount of money, whatever is stated on there, if that's not correct, they've committed a felony. And so, what's very interesting is that, in theory, the government could go back. It's never going to do this, and prosecute tens of thousands of people when it has to modify these loans because now people are going to have to prove their income. 2005, 2006, most of the loans we're in trouble with now that are clearly defaulting are people who didn't prove income. And again, that was the other reason why I got out. I saw more and more of my business going that way because the guidelines were making it so much easier to get into houses. Nobody bothered to prove their income anymore. It almost became a running joke when somebody actually had both a down payment and actually proved income. We would almost do a double take and say, what's wrong with this deal? Would they don't want to go stated income? And when you start realizing that you're acting that way and you're going, wait a minute, this has now become the standard. This isn't just, my standard. This is the industry standard across. And you're going, wait a minute, and it's the old, well, just because he jumped off a cliff, are you going to jump off a cliff too? Well, apparently the answer is yes, because a whole bunch of people did it, and we certainly helped facilitate it.
It's almost funny because I got this scenario. Here's somebody sitting down with a broker, and the broker says, okay, so you want a loan for $250,000, no credit history. We really can't prove your income. So let me ask you this question. Are you alive? Yes. Okay, then you're approved.
Well, and here's the interesting thing. Paul Jackson, my friend and publisher here for Housing Wire, was a doctorate student 4 years ago at USC, finishing up his doctorate in marketing. And he said, one of the reasons he moved to Texas, where he lives now, was because he couldn't afford the housing. Again, think back 3-4 years, prices are starting to peak out there. He goes, and he remembered sitting with a broker. Now, mind you, he's earning a doctorate salary of like $30,000 a year. And he's got a local broker in Orange County, California, telling him he can get him approved for an $850,000 house.
Wow.
And now, Paul's a pretty smart guy. And he's kind of looking at this going, I don't care what you can approve me for. I can't afford to make this payment. On what planet am I going to be able to make this payment? And so you start thinking, yeah, absolutely, and question number one, are you alive? Yes, and so you look at this going, it truly became absolute insanity. And I think one of the other things that forced me out was the volume of fraud that we started to see, whether it was consumer driven and or driven through the brokers, and that's largely where I think it was coming from, became so incredible that by the time we're at 05. We're estimating that 7 out of every 10 deals we're looking at that are coming in for approval, are somehow fabricated, manipulated. They've had some form of documentation has been withheld, and appraisal has been pushed, or something. And you're kind of looking at this going, I am having to spend all of my time double checking, triple checking every single fact in the file because I don't know who I can believe anymore. And again, it's and the irony was being a small lender. The irony was that everybody thought there was a ton of people making profits out there, and I'll be the first to say in our first few years it was very profitable. There's no question. That was an attraction to the industry. Again, higher risk for these loans, a higher reward. But by the time we had hit 2003, we got to a point that this operation wasn't making that much money, and we were carrying a tremendous amount of risk. And every year it kept, it was one of those things where you started watching your profit margins get significantly reduced. And as you probably know from reading the book, I talk about that in Chapter 6. Or, by the time I reached 2004, I went, really almost 2 years before I got out, we were already scratching our head going, okay, let's forget about the morality for a second. Just as a business model, just looking from the outside in, this isn't making sense anymore. Again, we're supposed to be managing for risk. And if we're taking greater risks, we need to be pricing for that. And nobody in the industry is doing it. Why? Because it becomes the old classic scenario of, well, we're losing 2 cents per loan, but we make it up in volume. Well, that doesn't make very much sense. And you start seeing that sort of mentality that overtakes the industry, and you realize a lot of it's being driven because of the large investment banks. They're now going directly to the consumers and to the brokers, cutting out middlemen. So they're squeezing everyone's margin along the way and going, great, we'll just pack in more loans into these securitization machines and make a hefty profit and the hell with risk. So.
Mm-hmm. Now, I think what's interesting, too, even though as the listeners have been saying, okay, well, we hear and kind of get a clear glimpse of the trouble with the industry, but as I found myself reading through your book, you were also, in many ways, offering solutions to, let's say that there is a person out there who is challenged with their credit, poor credit, but they really have this urge, this desire to turn things around. What I noticed is, as you read through Confessions of a Subprime Lender, is the fact that if you, first of all, come to be above board and honest, say, this is truly where I am at, that you can actually work with people who will become coaches, if you will, and guide you to getting to where you want to be and what it takes. And I think that's so necessary because, again, when you take a look at how all this turned into the mess in the first place, and I believe consumers were just as much to blame as the brokers, or at least pretty close, because they knew they were getting into a situation that was out of their own habit sphere, so to speak. Just as you talk about paying bills on time, what are their lines of credit, what is a rental history, how long have you been on the job, and you can take a look at a person's habits just based on that, and if they were being truthful, they could see to themselves, I don't have any business being here, but what can I do to change what I'm doing so I can be where I want to be? And that's what I really enjoyed about the book, is that as you were telling these stories about what was going on, whether it was true or fraudulent, that you begin to get a clearer glimpse about how important it is to really get into this game, just as if you were playing Monopoly, by playing by the true guidelines and the rules and just being honest.
Mm-hmm. I'm really glad you brought that up, because that was, I think that was one of the things, morally you kind of look at this, and I've had people who've, all kinds of responses. I mean, just face it, you write a book with the title of Confessions of a Subprime Lender, and, as you can imagine, you're going to get responses all over the board. Mm-hmm. The wild part is that, I slept pretty comfortably, and the reason I mention that is that I think there was a lot of us in this industry that had good intentions. I mean, did we do this to make money? Of course we did. But, we also did it for those of us who spent, like myself, literally my entire professional career in some level of the mortgage finance industry, where, you start looking at it and you're going, hey, look, my job is to provide financing intelligently to people. And intelligently means, to try to put them in situations that improve their livelihood, that, give them the opportunity and the ability to make payments. And so if you're doing those things and you're seeing your loans perform and you're seeing the reports that are coming in from your investors, it's hard not to feel good about what you're doing. I mean, in fact, I got to tell you, that was probably the best 3 or 4 years of my life from a work perspective, because I thought I had it all. You're making money, you're doing these kind of things where you feel like when you're doing it intelligently, it makes sense. And the reality was, what a lot of people forget in all of this is that, when you get a mortgage and it gets reported on your credit report and you pay it on time, okay, you can take someone who's got fairly, mediocre credit and improve it fairly substantially from a credit score standpoint because of the weight that a mortgage that pays on time provides to somebody who might not have a whole huge credit profile that's established. Mm-hmm. That's a step in the right direction. Again, all of it's predicated on the assumption that you're making a decent risk-based decision for that borrower. And so, when you're able to do that, it's like, man, this makes sense. A person gets into a loan for 2 years, they improve their credit, they refinance out of the arm, it makes sense. Of course, one of the challenges and one of the great fallacies, admittedly, of the industry, and I'm part of this, I've got to admit it, is that a lot of people who get the financing, may not have been the kind of borrowers who, had developed the problem. They lost a job, they got sick, they got whatever. They might have just been folks who, frankly, never really developed good credit habits, and they've kind of been habitually late their entire lives, whether A, they don't care. B, they don't know. C, they've never been told. And so, unfortunately, there was a certain sector of the subprime population that, you could almost use the term and say, once a subprime borrower, always a subprime borrower.
Mm-hmm.
And we'd like to think and believe, and I think we all approach this with the belief that, hey, you're going to get better, right, Mr. Borrower? Yes, you are going to start paying your bills on time. Aren't you? Yeah, of course I am. Well, of course everybody's going to say that, whether they do or they don't. Once they've left the office is another story. And so,
right.
But then again, the reality you've got to remember is people who don't have good credit, okay, who have less than perfect credit, have the ability to finance a lot of things: credit cards, insurance, auto loans, homes. Okay, the fact of subprime financing is not unique just to the mortgage industry. The difference here, of course, is that we as an industry absolutely lost our mind relative to our ability to manage that risk. So that's, of course, why it's front and center and why we've got these problems. So again, on the surface, it made a lot of sense. It was an industry that I think in many respects had great intentions, but clearly went and drove itself off a cliff.
Now, Richard, even though we're running short on time here, I'd like you to, if you can, give us an idea how long you think this financial mess that we're in will take to fully unravel and correct itself.
Great question. I actually do a fair amount of speaking around the country. In fact, we'll be at the National Security Traders Conference for their annual convention in a couple of days in Boca Raton, speaking on this very subject. I still think that in general, and let me refer to, and I'm going to largely address this from the housing market. Because, again, I'm not an economist, but relative to housing, I think that you're going to see still a period where nationally it will take us between 3 to 6 years from today to reach a bottom. Now, let me explain to you why I think that. First and foremost, we don't have a basis for comparison here. We've never really gone through anything like this, although we've had regional markets that have. Southern California in the early 90s, Texas in the 80s, the Northeast in the 80s. And every one of those situations on a regionalized basis, we've taken no less than 4 to 5 years peak to trough. Okay, so there should be nothing that would make any of us believe that we're going to get through this any faster, based on the fact that I think almost universally everyone would agree we have a much bigger problem that we're facing. We're 2 years into this. So, even in a best case scenario, I still think you're probably, if it follows previous history on a regionalized basis, you're probably still looking at best an additional 3 years. There are several things that ultimately drive markets, credit availability, affordability, and inventory. Right now we're still at roughly 10.5 months worth of inventory in this country. 5 to 6 months is considered in balance. We've started to trend downward, but that's largely due to the fact that lenders can't keep up with the volume of foreclosures that still exist out there. That number will still head back upwards. Affordability, we got into this mess, and the reason why, you talked about it earlier, Daniel, people taking out loans they couldn't afford, is that income has been stagnant, yet home prices rose. Well, we've seen them drop, but we haven't seen them come back to the levels of where those two were in balance, income and home prices back in 97, 98, before home prices took off. So I still think you've got that curve for a way to go. And then, of course, the last is affordability, which is a separate part of the conversation, but it largely has to do with, credit availability, and that really has to do with what kind of credit is going to be available to consumers. And I think what we've largely seen, due to the changes that are coming in securitization, is that we will probably never see anything that even remotely resembles some of the subprime credit that we had in the past. And you know what? That's not necessarily such a bad thing. So if the credit continues to be tight, inventory continues to rise, or at least stays at this level, and affordability still is kind of out of whack, it takes a while. This is the 800-pound gorilla. You can't turn this thing on a dime, and housing markets don't recover at a moment's notice. So anyway, that's my prediction. It's not meant to be a dire one, but I think it's hopefully meant to be one that looks at the market with eyes wide open.
Well, and not only that, for those people out there, who would like to seek good opportunity, I would think this would be a good time to get in, because, as you said, this should take about possibly up to 6 years to bottom out. So that means that you have a little bit of time to kind of get into the game and get things in a situation that could create some ideal opportunity in the long run.
Yeah, absolutely. My theory is, people are always saying, you think this is a good time to buy? And, my theory has always been the same. If you want to buy a home, You need to be buying a home because of the very reasons why people buy homes, which means you're buying up, you're moving, because you've changed jobs. You're buying that not because you're trying to look at this thing as an ATM machine or an asset to be flipped, but to look at it as a home for a long-term purchase. So,
right.
My theory has always been, if you're in a situation, you've got kids, you're living in an apartment, you can afford to get a home, and it makes sense for you as a family today, then do it. There has never been as great of a time to buy.
Mm-hmm.
But at the end of the day, if those things aren't mandatory, the reality is there's no shame in renting. We got into this problem for a couple of reasons. One of which was that this government of ours, both the Republicans and the Democrats, clearly created a mandate to house more people in this country, and then created a deregulated environment that largely allowed investment banks and rating agencies to become the de facto parties responsible for regulating this industry. So there was nothing wrong with the mantra. At the end of the day, the problem was that nobody was overseeing the operation, essentially, that was impartial or had some sort of a regulatory oversight to this. And that's what, again, ultimately, I think at the end of the day got us in this mess.
You kind of wonder sometimes, too, just in brief, because as we're running short on time here, is the fact that maybe they did know, and they just chose to look the other way until it got so bad they just couldn't do it anymore.
Well, and it becomes a great question. One of the greatest contributors to political campaigns were Fannie Mae and Freddie Mac. And, you start looking at that and going, it used to be a running joke in our industry that Fannie and Freddie used to continuously hire senators' nephews, nieces, daughters, sons. No, I'm serious.
As part of their campaign. That's what makes it funny.
So you look at this and you go, yeah, beautiful, just beautiful. So what a mess we've created.
Well, Richard Bittner, it's been a pleasure to have you here on our Beyond 50 radio program. And again, the book is Confessions of a Subprime Lender. Now, you do have an online blog. I don't know if you have a newsletter, but if you're willing, go ahead and shoot out how people can find out about that.
Okay, that sounds great. Best way as with anything is always online at Amazon or your favorite bookstore, and if you really like to keep pace with understanding what's happening in the housing market, I recommend where I'm at today, which is housingwire.com. It's a free online news service that's probably the most in-depth place to stay in touch with the day-to-days going on in this market.
Well, very good. Again, Richard, it's been a pleasure to have you on our program today.
Daniel, my pleasure. Thank you.
You bet. Thank you. And again, for those of you out there, the book is Confessions of a Subprime Lender, and our guest, Richard Bittner. Wonderful to have him on the program today. And if you want to find out more about what we talk about and we want to get an earshot of our programs, just certainly visit our website at beyond50radio.com. That is the number 50 with a 50, and also sign up for our free weekly e-newsletter. Would also like to thank one of our sponsors today, ZRT Laboratory. If you're suffering from hot flashes, foggy thinking, sudden weight gain, low libido, mood swings, and other effects of aging, ZRT Laboratory, the forerunner in hormone testing, is your first step to ending troublesome symptoms. Visit them online at www.zrtlab.com to find out how their home collection kits can help detect and correct hidden hormone imbalances. Let testing be your guide to symptom relief and life-changing solutions that begin with you. And also, physician guidance recommended. I'm Daniel Davis. Thank you for tuning in today. You've been listening to the Beyond 50 radio program. Remember, live your day past halfway.